Have Chinese stocks become too dangerous to own as a U.S. investor? I'm going to go over my thoughts, and I'd love to hear yours in the comments below. Thanks for tuning in to the Tony DeNaro channel. Let's get right into it. Now, I've traveled a lot to mainland China and many countries in Asia, and one thing has always stuck with me in my travels in China. I would go to a restaurant or a nightclub or a lounge to hear some live music, and on my next trip, it would be gone. And I would ask my friends in China, what happened to that place? Why is it gone? The answer was always the same. They got too popular. And we continue to see that even today with some of the big tech and social media companies in China. In addition to the Chinese regulation and the Chinese government interference, we have the U.S. government getting on board. Let's go over some of the recent U.S. regulations that are affecting Chinese stocks. At the end of 2020, the SEC adopted measures that would essentially kick foreign companies off the American stock exchanges if they don't comply with U.S. auditing standards. This is called the Holding Foreign Companies Accountable Act. This act provided that foreign companies would be audited for 3 years in a row, and after 3 years, if they were not in compliance with U.S. auditing standards, they would be removed from the U.S. markets. However, a recent act was also passed in June of 2021, shortening that audit cycle to 2 years, which means the companies could be kicked off the U.S. markets as soon as 2 years from now if they are not in compliance. In addition to the U.S. government crackdown, the Chinese government itself has also been getting involved in the game. After the Didi IPO in the U.S. markets recently, the Chinese government did a crackdown on the company and had it removed from all the app stores in China, a major blow to that company. If we look at their stock, you can see what's happened, almost a 50% drop in the past few weeks. I'm going to just quickly look through some of the other popular Chinese stocks and talk about those. You can see Alibaba has fallen about 20%. This is the only Chinese stock that I currently own. NIO is down about 20%. JD.com is down 30 to 40%. Baidu is down almost 50%. Weibo is one of the standouts, and the reason that this stock has not fallen is they are looking at taking the company private, and they've offered a price higher than the current price of the stock. NetEase is down 30 to 40%. Sohu is actually up, although it's unclear what is driving that. Stay tuned for more information on Sohu. And finally, we have TenCent Holdings, which is listed in Hong Kong, but you can trade it in the U.S., and it is down about 30 to 40%. The question is, have you got the stomach for these stocks and the risk profile that they bring along with them? High risk, potentially high reward, or potential major liability? As I'm trying to get to 100 subscribers by the end of month 1 on my channel, I would appreciate if you take a moment to buy and hold that subscribe button, drop a like on today's video, and don't forget to give me your comments and your thoughts. Thanks for watching, and I'll see you on the next video.